Hello, friend. Do you feel like you've lost control of your real estate business? Do you feel unprepared for what is coming, or even worse, what is here right now? I'm Josh Bickford, and last year, from my seat as Director of Acquisition for one of the big corporate real estate companies, I saw the market completely flip. May 15th was the day that I knew everything had changed. The more I dug in and the more I worked to figure out what was coming, the clearer the answer became. High rates, deflation, and a really bad real estate market. And as I figured this out, I also saw the solution just as clear. Assumable mortgages. These are the end around to what is coming in the real estate market. This is certainty for your clients. This is affordable payments. This is a faster mortgage paydown. This is the way that you get around what the Federal Reserve has to do to get inflation under control. The solution that you have been looking for has been found, and you found it just in time. I created a free 3-part class to teach you why the opportunity is huge, how to find and secure and close these deals, and what it would look like to have this as part of your business model. I wanted to share the course so people could get a taste of it without, signing up or anything. So I'm putting it here for free. The entire course is free. This is the first lesson. If you want all 3, you can sign up in the link below. We'll link it at the end of the video as well. There's going to be a lot of people over the next few years who need our help in this business. The goal of this class is to show you how you can serve your community and how your business can thrive over the next few years. Don't give in to fear. Don't give up control of your future. The solution that you have been seeking out has been found. If you have any questions, you got comments, throw them in the comment section below. And without further ado, here is the first lesson in the Assumable Mortgage class. Welcome to the Assumable Mortgage class. Thank you so much for jumping in. I am so excited to go through this material with you and show you really why there is an opportunity of a lifetime sitting right in front of you right now. And assumable mortgages are not a new thing. When I first got into real estate, which would have been early 2000s, I graduated high school in 1998. And so 2001, I bought my first house. A lot of the learning I did early on, they talked about assumable mortgages because they were the Wild West back then. Those mortgages have all been paid off at this point, and rates have been down for so long that we haven't really dealt with them. So they're not a new thing, but they're not anything that people understand or know anymore. So it's really interesting. I think there's a lot of people who know that there's some opportunity there, but don't have no idea what they're looking for or how to do these or any of that. So again, I'm super glad you've joined us. This first class is going to be kind of about why assumable mortgages are going to be a big thing over the next few years. So I am going to show you where mortgage rates have been, and we're going to go clear back to 1971. I'm going to show you where they're going, at least in my opinion, based upon past history. And we're going to dive in and look at one deal so that I can kind of show you with a specific house what this looks like and why it is such a big opportunity. And then we'll finish up this first lesson with a little bit of comparison on that single deal with what it looks like to assume the mortgage that the sellers have and what it looks like to get a new mortgage. And then from there, what would happen if the house were to go down in value and you waited and interest rates continued to climb, what that would look like for your monthly payments, how much you'd be paying principal over time, all that kind of stuff. I want you to get a kind of a holistic view of what this is going to look like and why this is such a big deal. So with that, we're going to jump in and get started. I have a lot of notes here and things, so don't pay a ton of attention to me on the video. But I think it's important to start with what a buyer needs in order to buy a house. And really what they need is certainty. We've seen really volatile rates the last couple of months. And in mid 2022, we were seeing that too, where we saw a 3% increase over 3 months, and it just grinded the market to a halt where I am in Colorado. But a house is a long-term purchase. So people are going to need certainty in their payment, in their future, and those kind of things. And when everything gets really volatile and you could use the term scary or any of that, then a lot of people are going to pull back naturally. So a big part of why I think these are going to be so big is because there is no rate volatility in them. The rate is what the rate is, and you can see what the payment is. Because of that, I think that you're going to see higher prices on these because people will pay more for less payment. I think that these are going to be the houses that sell first. I think that these are going to be what people look for. Once there's an understanding within the market that these exist, these are going to be what people look for. They're not, especially if rates keep going up. We're at 7 now. If they go to 8 or 9 or 10, the certainty that these provide will be enormous. And I think you'll be able to get people off the sidelines when they have one of these homes. And if you're going to help them buy, you can move them from their 3.5% note into another 3.5% note because you know what you're doing. Huge advantage over people who don't, for sure. So when this really became clear to me, I was a mortgage broker 5-6 years ago, and I used to sit in all these closings. And when the attorney would be going over the different lines in the mortgage, so to speak, they would kind of bullet point it, but they would always go through when somebody was in an FHA mortgage or a VA mortgage, they would go through a line and they would say, this loan might be assumable under certain circumstances, and they just pass over it. And a lot of times I told my clients, like, if rates ever go way up, that's going to be a huge benefit to you. So it's a bigger deal than anybody makes it because rates have been low. But if they go up, and fast forward to last spring, I'm here in Colorado now, and I'm watching interest rates go up. And my job at the time, I'm director of acquisition for a big publicly traded real estate company. My job is to buy houses at scale and predict, forecast what they're going to sell for, when we're going to sell them, and what renovations we need. So it's pretty good at that. And we bought almost 375 here while I was in that role. And I was looking at a house that was an old sub 1,200 square foot home in a part of town you really wouldn't feel safe driving in. It was a 3-bed, 1-bath, kind of the first thing somebody would buy, or, not something that anyone aspires to. And when I was looking at the calculations of where the price had put rates, if somebody was going to get an FHA mortgage on that house, it was like $3,500 a month. And it just kind of stopped me because I was like, who is looking to buy $3,500 a month payment? Who's looking for that? It's not someone looking for their first house. It's not somebody who's not in a really high paying job. I mean, that's a lot of money. And that really kind of is where this all came from, because I started to see that. And I thought, wow, man, I know the market's been crazy and I know that prices have exploded, but I hadn't really equated to how much the low interest rates had increased the prices. So I started to learn that, a 1% increase in interest rates to get the same mortgage payment, you have a 10% smaller mortgage. That's a big deal. Especially now we're up 4% from where they were in early 2022. So, there's a gap there. So that's kind of where this started. And just the realization that there's not enough people who can afford what these houses are going to cost at the current interest rates. We're going to have to see the values come down in order for those to balance, or we're going to have to see the rates come back down. Well, the Federal Reserve is fighting inflation. And as you'll see here, when we look at where rates have traditionally been and what they look like in inflation fights, I don't think we're going to see rates go back down. So this data here, I pulled from Freddie Mac. So these are straight up Freddie Mac numbers. Wanted to show you, kind of historically speaking, 1971 through 2022, what interest rates look like. So in the 70s, you can see the average rate for the entire decade was 9.33%. In the 1980s, it was 12.36% for the decade, not for a year or for a couple of months, for the decade. And you can see 1990, which a lot of people would put in the 90s, but technically that's the last year of the 80s, which is odd to me. Um, that was the first time that the yearly interest rate on a 30-year fixed was under 10% since 1978. That's a long time of north of 10% interest rates. When we get into the 90s, you can see the average rate was 7.85%. You get to the 2000s, you remember you got the dot-com bubble, and there was a lot of, the Fed really started to get involved in economic stimulus and all that. And then we had, the Big Short and all of that crazy stuff, if you were around for then. In the 2000s, from 2001 to 2010, it was 6.06%. 2008 is obviously when the world ended, a great financial crisis. In the 2010s, all of a sudden the rates are way down. For the decade, we averaged 4.11%. And look at 2020 there, 3.38% for the year. That's nuts. 2021, we are at 3.15 for the year. And 2022, which rates didn't start the year this high, but for the year it averaged 5.34. We saw them go all the way north of 7, and we saw them in the low 3s. So it was a highly volatile year. If you look at that over the entire time span, 1971 to 2022, and it looks like on the camera, you can't see my little box that I have this in, the average is 7.8% over 50 years. So the average rate over that time is 7.8. I think it's really smart to look at 2008 through 2022 and just realize that that's the outlier. That's not normal real estate. That's the crazy market. Where we're returning is normal. If you go back to the last big inflation fight that we had in the United States, that was early 70s, and it didn't end until the mid 80s. And you can see when you look at this, that rates just climb and climb and climb and climb and climb and climb and climb until they can finally start backing him up. I think it was Ronald Reagan's second term before the economy finally started going. Like his first term, I wasn't in school yet, a little kid, but so I didn't experience that in our profession. But it was tough times. Like I can remember watching people on 2020 mailing 2x4s to Congress, asking them to save the housing industry. I don't think that we're about to go to that. But if you are convinced, or you think, oh, we're going to get back to 3% interest rates with what they did to property values and how much inflation we have and how the Federal Reserve is trying to fight to save the dollar, I don't think that that's what we're going to see. So I wanted to give you a historical reference point. 7.8 over 50 something years is the average. I do think, in my estimation, I think we'll see rates go over 10. I don't think that we'll see that hold for a really long time. But I do think that we're going to have to overcorrect to land back in a healthy market space. When I was a mortgage broker, we always told people 6.75 to 7.25 is considered a healthy market. That in the industry, that's just healthy. That's what they're supposed to be. And we haven't been healthy for a really, really long time. So next, I wanted to show you what this looks like with a specific example for a house. So all I did on this one, because I wanted to make it generic as possible, I went to a house locally where it said that it was assumable in the description. And you can see here, it says incredible opportunity to assume a 3.75 interest rate. As you'll see here in a minute, that doesn't tell people why this is such an opportunity. Nobody knows what that means other than, oh, it means the payment's less, but it doesn't show them how much less. So if you go into some MLSs in Colorado Springs, they actually put all the mortgage details into the actual listing for agents to see. If your MLS does that, you can see it right there and pull the interest rate and all that kind of stuff. If you can't see that, maybe you can go to Realist, which I've done here, and you can see when the mortgage was originated, how much the mortgage was, what the mortgage type was. And again, with assumable mortgages, you are looking for FHA, VA, or if you're in an area that's outside of cities, USDA. Those are trickier, but that's the mortgages that you're looking for that are assumable. So this one's an FHA mortgage. You can see $545,380 in October of 2021. And the house is currently for sale for $625,000. So Uh, Let me show you why this is such a big opportunity using this specific deal. So I have a little tool here. You have been emailed this, so you can use this with your clients. It is pretty awesome. The boxes that are in green are boxes that you are going to have to fill in to show them how this works. So I'm going to assume, because this house has been on the market for a while, that we are going to be looking at a purchase price of 600,000, not 625, 600. And we're going to put 10% down for our buyer. Obviously, every buyer is different. If somebody has 20% down, this looks different. If you've got a VA buyer with no down payment, you're probably not going to be able to assume anything until the mortgages and property values line up. So a little bit of structure talk there. But if you put 10% down at a $600,000 note, you would have a $540,000 mortgage. We're going to say it's a 30-year fixed rate. Interest rates right now we set are at 7%. And you want to keep track of where they're at. If they go up to 8 or if they're at 5, like this, that'll change everything. I looked up, you would need mortgage insurance here, and I looked that up using an online calculator. There's a calculation with that because credit score, down payment, debt to income all matters. It would be good to talk to your mortgage person when your buyer was pre-approved to figure out what that was. In this particular case, it's $171. Okay, starting date. I am recording this, what is today? March the 15th. So I'm going to put June 1st as our starting date, which actually needs to be July because you would not pay your payment there. So July 1st, 2023. And then our mortgage that we're going to assume here is $545,380. It's 30-year fixed. We saw that it was a 3.75% rate. And they started it originated in October. So we're going to say they started it. Actually, you know what? That would be December, the way that that's calculated. But we'll leave it at November. So you're going to not pay till the next month. And sometimes you interest forward and then it's 1 month past that. But we'll just say it's 11. This will automatically calculate the PMI if it's an FHA note. And you'll see down here, if this is an FHA note, you need to put, yes, this is an FHA note. So as you can see here, if you were to assume this house in the monthly payment comparison, bottom right, now these are negatives because it's an amortization schedule, so it's counted as a debit. It's annoying, but the math all works. So the payment, if you assume the mortgage here and you had mortgage insurance, this does not, and the mortgage insurance, this does not include taxes, insurance, or HOAs. So that would obviously be on top of this. This is just apples to apples comparison. First mortgage payment on the assumed note would be $25,254. We're going to need so let me show you here. Mortgage assumed, months left. So the mortgage balance here is $528,454. I did a HELOC for 10 grand. The math isn't perfect there, but there's everything that balances out. And the payment on a HELOC would be $125. Now, if you needed a big second mortgage because the gap was big, you probably would want to go fixed rate in a rising rate environment. But here for 10 grand, the seller can add, or the buyer can add a little bit to it. So we're going to need a $10,000 second mortgage, which adds $125 to the payment. PMI is $386.31, which gives you a total payment of $3,037.05. Now, assuming first mortgage and mortgage insurance on the mortgage at 7%, just one loan, the payment is $3,763.63. So your buyer would save $726.58 every single month over the life of the loan. That does not tell the whole story. If we go over here we'll look at our savings in payments and principal paid. The assumed mortgage is in blue here. You can see over the course of 5 years, you're saving over $43,000 in payments. And in 10 years, over $87,000 in payments. And in 5 years, almost $26,000 more of the principal balance has been paid down. And over 10 years, you have paid down $50,000 more of the principal balance than with a new loan. So you are getting cheaper payments every month and you are paying the loan down faster. That's amazing. And that is going to always be the case. The first 7 years of a mortgage is nothing but interest payments, basically. So if you get a loan that has already been paid on for 2 or 3 or 4 years, they have covered a lot of interest. They have not covered a lot of principal, which is partly why as values come down a little bit, that will tighten up. But you save money every month. You save money overall. It's an amazing opportunity for people who buy one of these. And you can see why somebody who has one to sell it, it's an amazing opportunity. If you go back to our home on Zillow here, they don't have any information in the listing about what an unbelievable opportunity this is and how much certainty they can provide and how much faster you'll pay the house. I mean, you can change people's family trees with this. It is awesome. So that was our example. Next up, I want to show you real quick. I want to keep all of these classes around 20 minutes. I'll show you real quick the difference between a high price and a low rate versus a low price and a high rate and how this changes. So we're going to use our deal we talked about today. $600,000 purchase price. You also have this tool, by the way. Mortgage amount should calculate. There we go. Current rate 7%. This will give you, now this does not include mortgage insurance here. So this is only the mortgage part. You can see today, if you paid 600 grand, if the value went down by 5% and you added 1% to the rate, so now you're at a 570 purchase price, a $513,000 loan and an 8% rate, you can see that the payment is actually higher. And if it goes down 2%, or the rate goes up 2% and the value comes down 10%, the payment's higher still. And if the value comes down 15%, but the rate's 3% higher, the payment is higher still. And at 20% down in value with a 4% increase in rate, the payment is higher still. So you can also see how the amount of payments over 10 years down here is way less with the higher price and the lower interest rate. Obviously, this is starting at 7. If you're starting at 3 or 3.5, the difference is massive compared to what it is like this. So if people know that they're looking at a long-term move, and you know that even if values go down a little bit, you're going to pay less over time. You're going to pay your principal down faster. There's a lot of reasons why you can get people off the fence with this and get them to say, yeah, I'm not going to wait for the bottom. I'm not going to put everything off for a while. Let's get one of these assumable mortgages and let's go. Let's find a good deal. Right now, nobody knows how to do these. You are getting a jump on everybody. And the opportunity for you and the opportunity for your clients is really big here. So that is the end of the first lesson. The second lesson, we are going to jump into how to find these, how to structure them, and how to present them to your clients in a way that they will understand, because sellers need to hear a little bit of that if you're trying to list these, and buyers need to. And honestly, a lot of people are going to see this and think that there is no way that is possible. So that is the end of the first lesson. And if you look underneath this video, there's another box for lesson 2. I hope you'll jump in right away, and I will see you there.